Okay, so today we're going to go over market internals. Those are the things we cannot see on charts unless you really know what chart to go looking for to find that information. And once you understand market internals, it can really take your swing trading and also day trading, especially, to a whole different level. We learned about market internals a long time ago, and we used two of them on our daily and weekly charts, and the rest were all for day trading. So there's something there for everyone. But once you understand the market internals, it literally elevates your trading because you get to see what's really going on rather than just what's on a chart. There's much more going on in the market. You might think one thing is going up, but that one thing might be going up when everything else is not. But the market internals let you know, okay, now's the time to buy this because it's not the only thing going up. Everything is moving also. So those are the type of things we look for. Um, Go through this real quick here. Anything we're doing today is for educational purposes, not giving any specific trading advice or anything like that. Becky Booth is my trading partner. She's on the Zoom meeting also, and she's the one who anything you see in a rectangular box, any spreadsheet, she's the one who does all of that. She handles all those numbers. I don't spreadsheet. I do not put stuff on spreadsheets. I just don't. So she handles all the tracking of data, the numbers, the wins, losses, and everything we do is based on those statistics. So without those numbers, we can't trade, and we share those numbers with all the coaching clients because they wouldn't be able to trade our strategies without those stats. And we've been doing that for a long, long time now, and it works for us. Along the way, if you have a question, just unmute and ask the question. If you raise your hand, I probably won't see it, but you can type it into the chat window. I'll eventually see it. Or just unmute and ask a question. Pretend you're like right here. Just, hey, just stop me and ask any question, anything you don't understand or you need clarification on. So, like I said, this is all for educational purposes. And some of you have seen this before, but these are the list of ETFs we trade, sectors we trade with options. There are probably 1,000 something ETFs, but most of them are not tradable with options realistically. Either they don't have options or it's the open interest and volume is so non-existent, you can't really do anything with them. And so there's a few others that are not on this list that's are tradable with options, but these are the main ones that give us a very diverse um, representation of various markets, and most of them have been around since at least 2006, and some of them have been around since the 1900 something and the year 2000. So we have a lot of history. So whenever you see a stat we have where it says 80 something percent wins, it's 80 something percent wins since day one. Every trade that's become valid, did it reach the first profit target? So we track all of that. And then we show you during one-on-one coaching sessions how to realistically trade those with options. Because as we all know, just buy a call or a put, time decay sucks. But how we trade, it doesn't matter what time decay is, as long as you're placing a certain number of trades each month and getting in at a certain price and not paying too much for an option. And we, in coaching sessions, I go over what paying too much means, how much is too much, and how to objectively determine that to give yourself the best opportunity to actually be able to make money just buying calls and puts, because we have been doing it since 2007 or 8 now, just buying calls and puts. We stopped doing spreads back in 2008. Just buying calls and puts, that's it, and it works for us. Okay, market internals is something a lot of people don't really know about. See if I can zoom in just a little bit more. Okay, market internals is something a lot of people don't really know about until you affiliate yourself with some of the serious professional traders who know about this and they use it, especially in day trading. Okay. So market internals, they measure what's happening. It's like I use the expression, it's like hooking up an analyzer to the engine of your car. There's stuff that might be going on inside the engine that you can't see, but when you hook the analyzer up, it shows you on a display, here's what's happening inside your engine. This is running this way, this is running that way, this is not running it quite. That's what market internals do for us. They look behind the charts. It's like what's actually happening in the market. And as it's described as they're indicators that measure the underlying strength or weakness of the overall market. And they can give you a really good idea of the sentiment, volatility, what's going on, and then we can make better decisions if we have a choice of A, B, or C, but the market internals are really strong on A and B, but really weak on C, then we can narrow it down. Okay, we're going to focus on A and B because the market internals are backing up what we're seeing on the charts, right? And instead of looking at price, the market internals go beyond just looking at the charts. And we first learned about these working with John Carter and Hubert Centers from Trade the Markets back in 2006, 7, and 8. And we used to trade, especially put call ratios um, on the NASDAQ in particular, because it works extremely well on the NASDAQ. And we used to trade that when the markets were just getting crushed in 2008. We'd be buying NASDAQ futures overnight and placing an order blindly using the market internals and waking up in the morning basically and having money in our account. I don't even think we even had a loss with the market internals back in the day. That was on futures. Now we use them on options. So what we're focusing on right now is using the market internals with options, and we only trade them using the major indices, the Dow, NASDAQ, and S&P, especially the NASDAQ and S&P. Dow would be the third. And then we also trade XLI and XLK because XLI is 90 something percent correlated with DIA and XLK is 90 something percent correlated with the NASDAQ. XLK is technology and XLI is industrials. So that high correlation gives us a much low priced alternative to trading Q's options, which might run $2,000 a contract, while an XLK contract might run only a couple $100 per contract. So there's something for every one size account. So before we go into this a little bit more, I want to take a quick look at the big picture of the markets. We normally start out with like taking a look at the big picture and see what's going on. So I'm going to switch charts real quick, and we'll come back to the market internal specifics. There's a lot of details. There's probably 3 hours of information, but we're going to focus on just one subset of it. So otherwise, there's no way we could actually finish it. All right. So what you're seeing here is the monthly chart of the S&P 500, SPY. Right here, we're back in the year 1999. This is a 40-period moving average. This is an 8-period moving average. All right. And you're going to find a 40-period moving average in almost all of our charts. Basically, we are looking for when price is above the 8 and it rides the 8, it rides the 8, it rides every pullback to the 8 is a monthly chart. Every candle is 1 month. And every pullback is a short to medium term buying opportunity when it's above the 8 and pulling back. Once we get a couple of closes below the 8, monthly 8, every pullback up to the 8 is a potential shorting opportunity. Shorting opportunity. It pulls back up to the 8, shorting opportunity. Pulls back up to the 8, shorting opportunity. Pulls back up to the 8, shorting opportunity. Shorting opportunity. Okay? And this is so we can actually use trade signals off our daily chart. So when we see on our daily charts getting sell signals anywhere in this area, take it. We get a big down and big rally back up, sell signals on our daily charts anywhere in this area, take it. Anywhere in this area, take it. Anywhere in this area, take it. So if we take the bigger time frame, we can do some medium term and long term trading, swing trading with options or shares by being aware of the monthly chart. So this was the crash of 2001 when the tech industry just got destroyed. And we went 2 consecutive monthly closes below the 40, the market will probably go lower, and it did. And as long as we have our techniques, our strategies, mostly on our daily charts to capitalize on these, we don't care if the market's going up or down. If the market's going up, we make money. If the market's going down, we make money. We actually make bigger dollars when the markets are going down because the volatility helps us. We want big volatility. We want news driving the markets. We don't care if it's driving the markets up or down, but we want something driving the markets. And that's how we make money with the markets moving, not stagnant and sitting still with nothing going on. As the market recovered, going above the eight, monthly eight, every pullback to the eight, buying opportunity, buying opportunity, buying opportunity, buying opportunity. And this is 2004. Every monthly pullback, buying opportunity. So for all the medium term investors out there, and when it pulls back to the 40, that's a long term buying opportunity for the longer term investors. Anywhere in this area near the 40, uptrending 40, buying opportunity for the long term investors. So think about this. If you're the medium term person, you can use the monthly chart as a gauge. Okay, it's pulling back to it's right at that level now. Now I start looking on my daily charts for the buy signals. That's the strategies we focus on, the daily charts. We have weekly also, but a daily chart is our bread and butter, the main thing we focus on. And that goes on. This was our 2008 market drop where the market dropped literally 50%. And the same thing, every drop, a rally back up, buying up, selling opportunity, shorting opportunity, shorting opportunity. Once we got back above the eight, every pullback's a buying opportunity, buying opportunity. And ever since 2011, as the eight crossed back above the 40, we've been in a massive bullish trend. There might be short terms where people in the news freak you out. They'll make you think the market's going to fall forever, but it's not. But they will make you feel that way. And we will capitalize on those moves with our daily chart strategies. That's not a big deal. It's 2011, the market pulled back to the 40, buying opportunity for the long-term investors. If you're buying shares, focus on the SPY, NASDAQ, and Dow. Here is where you buy for the long-term investors, not for individual stocks. The markets, the sectors. This strategy works for the sectors, not for individual stocks. Okay? If you want to do it for individual stocks, you have to do your own homework and make sure it's highly correlated with the sectors. So if the sector's moving like this, the stock moves exactly the same way, then you might be able to trade individual stocks. Okay, but usually sometimes stocks have a different life of their own. Once again, every pullback to the eight, buying opportunity with options or with shares. Here we are, 2015, pull back anywhere around here for the 40, anywhere near the 40, long-term buying opportunity. Long-term positions, medium-term position. You don't know how, and there's a way to trail stops and stay in positions also if you're trading shares, but these are all monthly charts. So there's nothing to do if you're looking at monthly charts, but just be aware. It's a great gauge. This was a pullback to the 40, once again, long-term opportunity. This was COVID. Pullback lasted a whole 2, 3 weeks, and then massive rally. Pull back to the 40. Everyone thinks the market's going to go down forever. Everything is shutting down because of COVID, and everyone's panicking. Don't panic. Trust the charts. You have to understand the big picture. This is major buying opportunity if you understand the big picture and trust the charts. You don't just go short. Okay. 1 second, let's gotta check. Okay, I don't have any new people. I'm also managing the people coming in right now. Okay, let's get going. Here we are in 2022. We had a pullback for a couple of months. Pull back to the 40, buying opportunity. Buying opportunity. It's just as the 40 gets back above the 8, every pullback is a buy to the 8 is a buying opportunity. Every pullback to the 8 is a buying opportunity. Every pullback to the 8 is a buying opportunity. We got to pull back to the 40. This lasted like a couple of days. Literally, this was a red candle all the way down to here. Anything in this area, buying opportunity long term. This lasted literally days and then this took off. I did a meetup where this red candle had come down to the 8 period moving average. And I was like, buying opportunity. Here's where people were freaking out because there's a war going on. There's always a war going on. People forget about that. There's always a war going on, but it's just in the news a lot. So oil prices are up. Oil prices go up and down all the time. Don't freak out over that. Look at the charts. Um, so major buying opportunity in March when we were seeing stuff, bad things on the news, but trust the charts. Don't get caught up on news. And when during the month of March is when we started getting our market internals buys. Market internals were telling us, hey, we should be setting up some long positions here, or at least not committing to go all short. And we had major multiple market internals buys throughout March and April. They all hit targets with options. But during this time when the markets were dropping, we got our first market internals buy in the middle of March and really good trades. That's why we really like market internals. And go over some of them. Is AR, oh, I have no idea what ARKK is. You would have to, if if that's a stock, there's some correlation tool, and it would have to be a pretty highly traded, massive, highly traded, high volume stock that's been around for a long time to check the correlation. So you only want to trade stocks that have been around for a long time that and extreme high volume to check the correlation with the major indices. So I'm not sure what that symbol is. I'm not, so you have to do some research on that. How long has it been around and what kind of volume is it seeing? All right. So, and here we are right now. And we got basically a down day on Thursday or Friday. Um, Eventually this will pull back to the 8 and it'll be a buying opportunity again. And we're going to see bad news. Going to be, oh, the sky's falling. We always need some news to make the markets pull back and then keep going. That's the way it's been since 2009, basically. Massive uptrend with periodic pullbacks. And when it pulls back to here, again, it'll be a buying opportunity. It's summertime now, seasonal patterns. The major markets tend to go sideways and bearish. So with the summer starting now, if this pulls back and goes sideways and bearish, normal trading. I'm also a big proponent of seasonal patterns and being aware of them. And that is one seasonal pattern. The sell in May and go away thing, that's what this comes down to. The sell in May, and then the markets tend to go choppy sideways and down, and then end of the year takes off again. But that's pretty normal trading pattern. So I'm not shocked if I see a down day because I'll probably see some more bearish moves back down to as this is going up, the price is coming down. They'll meet in the middle somewhere. Normal trading. All right, I'm going to switch back to the handout now. And along the way, if you have any questions, just go ahead and ask. Don't raise your hand, just unmute or ask it or type it in and I'll see it eventually. Okay. All right. So different types of market internals, the advanced decline line. We use this on our one of our weekly chart strategies. It's available on the Thinkorswim platform on TOS. New highs versus new lows, tracks the number of stocks making new highs and new lows. Up down volume, buying pressure versus selling pressure. And these are things that you can go research. I'm not spending time on all of these today except the pull call ratio, but it's things to be aware of. And if you are a day trader, spend some time learning about them and see if these can be added to whatever you're doing that can help improve your trading. Something to just be aware of and look up and research on your own. But today I'll be focusing on the put call ratio. The VIX, many of you have heard of, measure of volatility. Trend combines breadth and volume to gauge market pressure. The tick, we use the tick a lot we use it on our day trading. Um, but we don't day trade anymore. That was back in the day, but we use it very effectively. And the put call ratio, this is what we'll be focusing on for our market internals. This gives us a really good idea, especially on the long side. Gives a really good gauge on the long side when to buy. Okay. And I did put some quick definitions in here so that you know what, generally speaking, things mean. And you can reference that and do some more research on your own. Breath indicators um, will let you know whether the market is well, a lot of stocks are moving your way, or just a couple, or maybe the ones you're looking at might be going your way, but the rest are not participating. They're going sideways or the other way. So if you see the breath indicators um, all going one way and you want to be going the other way, that may not be a good idea. You want to be going where the big money is going, not counter it. People always talk about contrarian. Contrarian sounds good, but if everyone is buying, if the big dollars are buying um, in the short term, you want to be part of that. And when they start selling, you want to be part of that. Okay, so when big dollars are going up, you want to be going up. When big dollars are going down, you want to be going down. Being aware of things like that keeps you on the right side of trades. There's a time and place to be contrarian, but there's a contrarian, educated contrarian, just because. There is no just because. If you want to be contrarian educated, no, because we do contrarian trades, it works really well for us, but it's contrarian educated because now we have a reason to be contrarian to back up what we actually thinking and seeing. Volatility indicators measure fear and complacency, and so the general what they show. Sentiment indicators and the put call ratio is a sentiment indicator. It gives us a feel for what smart money might be doing with options at the top or bottom of a move. These market internals are used heavily and very effectively for the NASDAQ and S&P 500 and to a slightly lesser extent to the Dow. Okay. If you have a Thinkorswim platform, you will find a put call ratio for each stock. Stocks have their own put call ratios, and there are ways to use that information. There are certain organizations that use extreme put call readings as an indication something is going on with that particular stock because smart money is trading a whole lot of options on a particular stock. I won't say which organizations, but that's how they run their business. They have software that scans for unusual option activity. And unusual option activity is usually literally the put call ratio. It doesn't matter because every time you trade an option, it's visible to the whole world. If because it adds one to the volume count that's visible to the whole world and adds one to the open interest. So anything you do with options, a number shows up and it's visible to everyone that an option has been traded. They don't know who traded it, but the whole world can see an option has been traded every time you trade an option. All right. So key takeaways. Like I said, there's a lot of information on here, but you can go back and look at this later on and do some follow up with find some specifics or call me or email me later, and I can help you find exactly what you need to help you with your specific situation. But this is the key word right there. They confirm whether price movement is supported by broad participation. It's a confirmation. We're going to have a technical something that says buy, and then we're going to use the market internals as a confirmation. When we look at a chart, we don't see market internals. We get our buy signals and we see our sell signals. The market internals will be a sentiment indicator to help us confirm what we're seeing has a high probability of continuing in the direction of our trade. Extremely high probability of continuing. So our focus is going to be on the put call ratio. The other we do use the A to D accumulation distribution, but the put call is what we focus on our daily chart strategies and internal strategies. And it combines put volume to call volume. It's straightforward, put volume versus call volume. And high put to call, meaning a lot more puts are being traded than calls. Now, that can mean there's a bearish sentiment because more puts are being traded, but the put call ratio doesn't tell you if people are buying puts or selling puts. So it just tells you puts are being traded. That is why we need something else in addition to just the put call ratio. But put call ratio by itself won't help us. Okay. Just like the low put call ratio might tell you there are a lot more calls being traded than puts, but it doesn't mean people are buying calls. They could be selling calls and they believe the market is going to be going down. Okay. Or if they're buying puts, they could be thinking the market is going down, but they could be selling puts thinking the market is going to go up. So that's why we just need a technical buddy to go along with the put call ratio. So I'm going to, and we'll look at put call extremes. So here, the put call ratio is literally the put option volume versus the call option volume, real straightforward. Um, so what we're looking for is certain values of put call ratio, and we do provide specific numbers laid out over specific days, so on and so forth during coaching sessions. But as an example, if the put call ratio is 1.2 or higher, it means more puts are being traded than calls. And it might be a fair indicator because you might be thinking, oh, more puts are being traded now. This market might be pulling back. This is usually smart money trading options, not, I won't call it dumb money, but you and me are not the people in the know. Okay. The people in the know are trading options, big time, high volume. That's what we're looking for. That's what this is showing us. And it's being broadly traded way beyond what you and I can trade, so to speak. But what we do is take a contrarian look. So this works extremely, extremely, extremely well on the long side. So how we use the put call ratio is after the markets have been dropping, it could be dropping for days, it could be dropping for weeks. And then we see on our charts a buy signal. Okay. But a buy signal by itself isn't an opportunity. When the market's going down, we don't see a buy and say, okay, we're going to get in now. We need some kind of confirming trigger that tells us now the more we got a signal, but now the market is actually turning around and going higher. That's where the put call ratio comes in. So we get a buy signal, and then it's also right in line with a put call ratio that can support what we're seeing on a buy signal. It's a confirmation. It's an extreme reading of the put call ratio, right in line with what we're seeing with our trade signal. So suddenly we get a buy signal so the market's been going down, 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 and our charts with our indicators we get a buy signal. Do we just take that buy signal? No. We need a confirmation, and the put call ratio, an extreme reading of the put call ratio becomes our confirmation because not only are we seeing this market something telling us it might be going up, but there is an extreme amount of option volume right at that low point, telling us there's something people in the know are trading a whole lot of options down here also. And that's an indication that we might be seeing a rally because smart money is putting in a lot of options. And right at that same point, that's we're looking for it to go higher. Okay. That's your how we use the put call ratio. We look at it for buy signals. We don't look at it so much for shorts because on the NASDAQ, it works well on shorts, but on everything, the three major indices and its correlated partners, it works extremely well on the long side, extremely well. So if we have a really low put call ratio, I'll use this as an example, once again, exact values we provide during coaching sessions, it's not that straightforward. Um, but we look at it from a contrarian point of view. We're not saying, oh, we're trading more calls than puts, so we have a low put call ratio. We look at it from markets have been going down, 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 down. So, and now we see a lot of calls being traded at a low point. Okay, we got a buy signal. and we see a lot of calls being traded, beautiful. But we need some, so that's our confirmation. So on the puts, excessive put trading, we look at it from a contrarian point of view. It could be puts being sold, but we had a buy signal with an extreme high put call ratio. We look at that from a contrarian point of view. We're not seeing it going lower, we're seeing it going higher. And for the um, low put call ratio means extreme numbers of calls are being traded as the market's going down. So suddenly a lot of calls are being traded. Smart money is saying, hey, we think this is now the time for the market to start going up. So that's how we use the put call ratio.
I think if you're also looking at the VIX, the volatility, the fear index, that would also be a clue.
Yeah, as long as you can find some way to correlate it. We don't we trade and have traded a whole lot more than you've seen or heard of, Olga. A whole lot more. We used to trade the VIX a lot and with the similar type of things. We don't do those anymore. The ones we focus on now are the ones you're familiar with. But all that stuff with the VIX, that was part of our trading world. It still works, but we just don't do it anymore. We kind of narrowed down our scope of trading to just the ones you have seen. But yeah, the VIX is very tradable and very usable to trade with for longs and shorts. We used to actually buy calls and puts on the VIX and use it as a sentiment gauge also.
I never heard of the trend that you have listed there
Yep.
under internal, the TRIN. I don't know what is that?
That you guys spend time researching on your own.
Okay.
It's mostly for day trading.
Hmm.
It will give you real-time information that can help you pick a direction. So the tick and trend are two things that you can see in real time that can help you choose a direction or at least keep you out from going one way. The ticks are telling you if everything is ticking higher, so to speak, and you want to go short, maybe it's not time to go short. Okay. So that stuff you have to research. That's why I just put that information there for people who want to spend a little more time on it to be aware of it. So once you're aware of something, now you can go and look it up and spend a little more time on it. A lot of people are literally not aware of the market internals, and the market internals are great, especially if you're a day trader. If you're a day trader, the market internals are key, really, really key. They really take your day trading to a different level if you learn the market internals. All right. So there are two different types of put call ratios, one for individual stocks and one for the overall markets. Okay. And so we have overall individual stocks, and we have a put call ratio for the indices, and there's a total put call ratio. The total put call ratio is what we use for our internals trading. It's available on the CBOE website. I'm going to go to that now and I'm going to show you that. Let's see. That updates once a day. Couple hours after the market closes is when that will update. And it's the CBOE website. I will put the link to it in the chat window so everyone has it. So check the chat window for the CBOE website. And here's the put call rate, various put call ratios for the day. Okay. And if you look on TOS, each stock has its own put call ratio. So you can, depending on what you're trading, you have the put call ratio. And if you have some software that can manipulate the numbers, you can correlate extreme values of put call ratios to individual stocks. So if the normal put call ratio is like average is normal zero point 0.9 something or 0.93 or 0.92, all of a sudden it's 1.3. What's going on with this stock and is it associated with any buy or sell signal? So, and you can look for patterns, but once you see the extreme values of put call ratios, then you can do some research for yourself and find patterns with a particular stock. We focus, like I said, we focus on the indices, not any particular stock.
Oh,
We use
so when you're referring to it on the printout
yep,
for some of the strategies, are you looking at the total put call
yes.
ratio or the
It's, to-
index?
it's a
The
total put
total.
call ratio. I think we
That's the
like
one
that.
that you point out. Yep.
That's
Mhm.
correct. That's the one. And you can go to any date you want to get the put call ratio. Once upon a time,
Friday looks very normal, doesn't
yeah, yeah,
it?
yeah. Some people freak out. Oh my goodness, we had a down day. The market's gonna. No, it's just a down day.
What was the day before? Was there
It's
any
a down day.
indication that
Yeah, it's not a big deal. It's not a big deal at all. It's just a down day.
what was it on the 4th?
Let's
Was
see.
there any indication there was going to be
Okay, on the
that
fourth,
that drop?
put call ratio, that's pretty low.
Wow, yeah,
So there was something going on
something,
the
yeah.
index, and the total was something going on. So we don't focus on the short side. Um, Not that we can't, but it would only work on a NASDAQ. Once we did this a while ago, it only worked on a NASDAQ really well. The rest were not so great. But NASDAQ is one of the number one things it works on. But like I said, if we have other trades to look at or other strategies to look at for the short trades, but like I said, we personally don't do anything on the short side with the put call ratio. Not that it doesn't work, just that we don't do it. Um, because we wanted to work on all three major indices and it was only working well on the Nasdaq. That's the only reason we don't use it. No other reason. Not that it doesn't work, is that we wanted to work on all the indices really
Wouldn't
well.
wouldn't the average true range also be a market in would
Not
be under
really.
that?
Not really.
Not
This
really.
is the volatility. Markets go up and down each day. It goes a big up day, big down day. It's good for us for our targets. The bigger the volatility, the bigger the ATR, the bigger the target, right? We make more money.
Mhm.
Some people are afraid of volatility, and we need volatility for our type of trading. We want the markets moving big because, especially when we get a bigger ratio of our ATR versus option price, the bigger the target, the bigger the money. So, and the bigger the profits. So for us, we don't it's nice to say, oh, the market's going up and up and up, but the markets go up and up and up slowly. ATR gets smaller and smaller, and our first target gets smaller and smaller, and our profits get consistent but smaller with each trade. So on a nice uptrend, we might make a 15 to 20 something percent return on our first target, on a first profit target, but on a when it's big time volatile, we're looking at 25 to 40% return at the first target because the ATRs are that much bigger, our targets are that much bigger. So you make more money faster with the more volatility. Just don't be afraid of it. Just when it happens, it's like capitalize on it quickly. We didn't get too many sell signals this weekend. It might pull back, but we didn't get too many sell signals yet. We got just a couple so far. So, but we do have some other sell signals that have been in play on the Nasdaq. So we'll see if the Nasdaq pulls back some more. Anyway, this is what we look for the total put call ratio. But once upon a time, the CBO maintained a spreadsheet where they would update the spreadsheet every day. And so you can actually just download the whole spreadsheet. Okay, so you can actually download the spreadsheet with all the values, but they don't do the spreadsheet anymore. Now they just have it on a calendar. So if you want to do your own database, and like Becky updates this every day, so she maintains a spreadsheet of the put call ratio each day. So like Olga, when you get the email from us with the daily trades, if there are any, um, you don't see the entire email that Becky sends me. I just edit it down to what was over 84%, and I send that out to you. But what she sends me is here's the put call information for the day. Here's what we found valid, and so on and so forth. Or if there's anything new valid, but she updates that every day and puts that in her own spreadsheet. So she has that going back to 2006 with the put call ratios of 2007-ish. So that's an ongoing tracking thing, and it's good to have that information because once in a while I go looking for how can we improve on a put call ratio, but it just works extremely, extremely well. extremely well. I'm going to switch off to a spreadsheet, show you back to the actual handout a little bit. Like I said, there's a lot of information here. We only have an hour and a half, but call me later if you want to go over more or for coaching stuff, and then I can get some more time. But basic put call. I, I showed one strategy in here. This market internals is a total of 6 different technical strategies. The technical strategies are really simple, really simple strategies. They're just looking for 2 lines crossing type of thing, or looking for a little hook or color change. But the confirmation is the put call ratio. The rest is just trade management. But we're looking for a bullish cross and a put call ratio being valid. This is a recent one, or not recent, that's using a good example, of crystal clear. Um, Bullish cross is, this is called the T lines, and market pulled back for a week or 2 or 3 weeks and then took off. Okay. We have a very established way to determine how much time for the option, and it's usually 1 to 2 months worth of time. But as long as you follow the rules for how to determine the option, time decay is not an issue. As long as you're consistent with your trading, time decay is not an issue. I always say that, and some people will focus energy, but this one trade at time decay. There was time, then they focus on this one trade with time decay. That's not trading. Trading is the net results of many trades. Are you profitable or not? If you have, as an example, let's say you place 10 trades, and on 2 or 3 of them, you get maybe 10, 20% time decay. So they're worth a little bit less at the first target. But on the other 7 or 8, you get a 25 to 40% return on your money on each of the just first target, no trailing stops, no nothing. Just why do you care about the 2 trades where you lost 10% or the 2 trade or 20%? But that's what people focus their energy on. They completely and totally disregard the money they're making and focus on this in the tiny loss that means nothing. But they always focus on that. But these 2 trades are lost 20% on. You made 40% on that one other trade. They negate each other. You just did nothing but make money on your last 10 trades. You got to look at trading isn't one trade. Trading is the full breadth of your trades over time. If you're swing trading, then you might review your trades once every month, once every quarter. Not every day, not every week. That means nothing. If you're a day trader, maybe once a week. That's okay. But if you're a swing trader, once a month to make sure things are going okay, once a quarter, or then what the annual results. But you can't micromanage yourself if you're swing trading, just as long as, because you have to understand it's not about one trade, it's about 10, 20, 30 trades. Over those 10, 20, 30 trades, you have to have an expectation of profitability. If you don't know your numbers, it won't work for you, because it's a business. If I ask you, if you place 20 trades, what's your average percentage return on a win? And you can't tell me. And then then I ask you, well, what are you risking on a trade? And you give me some random number. Well, how do you know you're going to make more than you lose? And most people can't answer that. Literally can't answer that. So that is why we approach our trading as a business. If I place 20 trades, how much do we expect to make? And you have to have a realistic number for that. That's why when I work with you, we determine that if you make 10, 20, 30 something percent on a trade, how much can you risk? And on certain trades, how much more will you make? And I'll show you how to make a lot more then. Taking this exact same trade here, you get in. Some people would get in. Some people would get into this. I'm gonna switch to the actual chart. It makes it easier. This is in 24. I'm gonna switch the share to the actual chart and look at it. Before I do that, I did include in the handout for the Qs. Here are all the trades on the Qs since 2006. It's a solid 93% wins on the Qs for this one strategy. Remember, we have 6 strategies combined for the market internals. This is just the T lines buy on the QQQ since 2007. It is 80 trades. This is right through this past weekend, or this past week. 80 trades, 74 wins, 6 losses. These are actually long terms our most profitable trades because of the time in the option. It's just a way more profitable than the other daily chart strategies. So add market internals to what your regular trading and cha-ching. All right, but I wanted so people can go reference this on their own. And if they want to do recreate stuff on their own, that's great. But I wanted to show people here's what the put call ratios were like. And we give very specific information to qualify the trades during in a trading plan for the put call ratio, very specific. Um, these are, let's see, these are a sampling of the market internal trades in the last over the last 1 year, basically. These are more recent. I have the actual spreadsheet I'll pull up also. This is just in the handouts as a personal reference. These are the different strategies. The gap and go is one we really, really, really like. It averages about 90 something percent wins when this happens after a pullback. Picture the word gap and go. Market pullback, there's a gap, go. Got that expression working with John and Hubert, also trading markets. It's a gap and go. It gapped and took off. Gap and go. Um, this was a market internals trade after a pullback. I said we started getting our buy signals in March. These were our first buy signals in March when the markets were going down, 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 down. And people saying, oh no, the price of oil is, there's going to be a war forever and everything's going to, and, we're paying too much for beef and bacon and whatever. Everything costs too much. It still costs too much. But people think the market's just going to go, just keep going down. And they forget it's not all driven by oil. It just seems that way once in a while because that's what they cover on in the news. Um, Remember, company earnings, number one for driving the stock market. But we got our buy signals, so we were able to position ourselves with buy signals with the long trades to just capitalize on this move up in the markets. It was the beautiful rally. Some trades from February went against us, but even these trades came back in value. All right, so that's why we like the market internals. They work really, really well for us. And if I switch over to change the share, go to the spreadsheet. Let's see. Combine the internals bias, QQQ. Okay, and share. Okay, this is the actual spreadsheet that goes back all the way to 2007. Okay, so like I said, Becky's the one who tracks all this stuff and maintains this database. He's the one who went through and got all the put call ratios and um hey, we had a couple losses in 2008. And then after that, look for the red. Not a whole lot. 1 month of losses and a whole bunch more of wins. So this whole spreadsheet is maintained. It's not that there are no losses, it's just that there's so few losses and not a big deal. Okay. And now we look at the big number. Since 2007, it's 1,511 trades and 210 losses, 88% wins. So will losses happen once in a while? Absolutely. But they'll usually all bunch together. They'll be bunched together because the market just turned around and went down or something. But that's not a big deal. When you see a loss there, it means we have wins elsewhere. We don't just trade one strategy. We buy market bottoms. We buy markets that have started moving up, and we buy markets that have an established trend. We short market tops. we short markets that have an established trend down. Okay, so we're always buying bottoms, buying markets moving up, then buying established trends up, shorting market tops, and then shorting markets that have established a trend going lower. Okay, so we're hitting, so when you see a loss one place, we have a win elsewhere. That's why we go back to um, our overall daily chart strategies where and I put this out update this every couple of months, send it out. This is on our website also. You can just go to the website and download the spreadsheets. We update that regularly so people can follow along. Um, I always believe there are always people out there who will say, "Well, that cannot work. That cannot possibly work." Okay, show me it. Show me it doesn't. I literally like people who show me it doesn't. Same thing I did with like kickboxing. People were like, "Yo, kickboxing." Well, show me what doesn't work. I took it internationally, took my kickboxing program internationally and my fitness program, all the major organizations supported my programs. And for those critics out there, well, show me what you got. That's better. Show me anything I'm doing that you think doesn't work. Show me. I'm always open to learning and growing. So show me. And no one could ever show me anything that didn't work. So I'm always challenge people to like, hey, you think something doesn't work? Great. Show me what doesn't work. And that's why I put everything out there so people can challenge it. I want people to challenge anything I do. Um, because if I can show me a better way of doing something, I would appreciate that. Let me get this share down. Okay. All right. So I put it out there. This is a list of all the trades right through the end of May for this year. There are losses a few months ago from trades valid a few months ago. For the year so far, we have had 124 trades that have either hit the first target or were full losses. We don't even put stuff on here as a win. If it came within a penny of hitting the target, we counted the loss because it hit the target. Doesn't mean it won't make money, but we don't show it as a win because the target wasn't hit. And some of the stuff on here that might show up as wins, or excuse me, as losses, could actually have been wins because we actually moved more time, but that's a little detaily things. This just purely was the ATR hit, target hit before expiration date. Um, and this is worst case scenario, not best case scenario. And a profit can range anywhere from 10, 15% of the first target all the way up to 70, 80, 90% return of the first target just by how we choose to manage a position or when we get into it. So you can a lot of it, and I show you that during coaching sessions because we can turn a 15, 20 something percent win into a 50, 60, 80% win. And that's return. It's not that hard, but requires patience, the P word. You have any questions so far on anything? Anything at all? Okay. So let's see, what time is it? 1:34. Okay. So I'm going to switch back to the handout and take a look at that again. I put a lot of stuff in the handout, a lot. So when you look at that, ask any questions. You might have put call ratios on the CBOE site that's in the chat window as a quick reference. See handout. Okay. All right. So I said this is just one strategy, and I was going to show this on an actual chart. Share. Yeah, daily. All right. And I'm going to do QQQ, that exact same trade, show you how a 10, 20% return can become a much bigger return really fast. And that one was, getting the date on it, 11/24. Get this trade here. All right. So this one in the handout is this trade here on the Qs, and this is November 7th, 2024. There's our T lines, our trigger lines. We're looking for two lines crossing. We're looking for, after the market's been pulling back, we're looking for something to indicate it's time to go long. You see when it pulls back, when the T lines cross, when it pulls back, T lines cross. But note, we didn't have a buy signal. We didn't have a sentiment indicator here saying we should be going long the NASDAQ. Okay. We go back and look at the spreadsheet. But here we did. So we got our buy signals when the two lines cross, when one line crosses above the other. This is the trigger lines. You place the trade the next day at or below the open price of the ETF, below the Qs, and it'll go against you for a couple of weeks and then takes off, hits the first target, which is usually a multiple of the ATR, either one times or one and a half times the ATR. ATR that day is 8.36. ATR's average true range. We do not do analysis on options. We do the analysis on the underlying ETF. We use options to profit from the opportunity. Okay. With a lot less capital, we can have a very nice return profiting from the opportunity with options, but we don't do all that complex analysis stuff with options. Learned all of that complex stuff a long time ago. Got really, really, really good at it. But for the long term, once I left my regular job and just wanted to trade, there is no way I could trade spreads the way I was doing it and make enough money to do anything meaningful, especially having to correct trades gone wrong and make adjustments. And no, that wasn't, this is much more effective use of available capital, just buying calls and puts and having expected returns and so on and so forth. It's way easier, but you have to have some rules attached to it. If I just take this trade as is, place the option trade the next day, I'm going to get a 15, 20 something percent return. It's going to go against you, then it gaps up right to the first target. Good trade. But let's say you have a life, you have things going on, you have a family, you're on vacation. Here, the target is 8.36. The ATR is 8.36. The entry price the next day is 513 or lower, 513.03 or lower. Let's say you have stuff going on, you're busy, you can't get to it, you have to work. You don't get to it till sometime this day. The low this day is 507.77. But you really got busy and you go to the next day. You really want to trade it that day, but now you're getting in the next day. It opened at 502. The entry price was supposed to be 513, but now you're getting in at 502. You're getting in 11 points better than expected. Let's just make it this, let's say your ATR was 8.36 and your entry price was 513, open price the next 513.03. Your target's up here. Add the ATR to the entry price. If you get in down here, open 502.94. Let's say you got in at 503, you open and went up a little bit, got in at 503. Your target is still up here. Here you were getting in at 513. Instead of getting in at 513, you got in at 502. You got in 11 points better than expected. Your target is now 11 points plus the 8 is 19 points. You now have a 19-point profit target. Get in here. Your profit target is 8 points from the open. Get in here. Your profit target is 19 points from where you're getting in. This is still a target. The probability of it reaching here is still 90 something percent. It doesn't change. What changed is here you have a, a nice trade. It's going to be 15, 20 something, but now you have a better trade where you can make more money, a lot more, exact same trade. Whether you're getting in here, 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 or here, any of these days, as long as you're below the open of this day and the target hasn't been reached, the same 90 something percent probability of reaching your target over here is exactly the same no matter which day you get in. The difference is how much money you're going to make. You get in down here, you're looking at a doubling your money or more at the first target. Here you're looking at a 10, 20 something percent return at the first target. 10 different people taking this exact same trade will get in 10 different days, 10 different times, 10 different strikes, get 10 different results. You do the basic stuff right, they'll all be profitable, but very different levels of profitability. The people who want to get in right away when the market opens, great. Your trades, your trade's on. You don't have to worry about it. You'll get probably a profitable trade. It may not be big dollars, but you get a nice return, 10, 15, 20 something percent return. If it gaps up, even better, it goes even more high than that. But if you are patient or if you don't care, I use the word don't care, or you have other stuff going on and you just get in whatever, see what, or let me see what's valid this week. Oh, wait a second, this market internals trade was valid 2 weeks ago. I'm over here now. Let me get in the next day and I'm getting in at 506. I should have been getting in at 513, but now I'm getting in 6, 7 points lower than expected. I'm still going to get a really nice trade with a much bigger than expected target. Here I had a 6.8 point target. Now I have a 14 point target because I'm getting in 6 points better than expected. Exact same trade, much bigger returns. That's how we improve our profitability without having to do anything other than be patient. If you Anytime you can get in just even a point or two better than expected, it changes the outcome significantly. This is usually by luck that you just didn't place the trade or you forgot about it or you couldn't get to it, you didn't have capital available, whatever it might be. And you get in anywhere you have 1, 2, 3 weeks to get into this trade and you get a much, much better return than getting in right at the open the next day. Okay. Olga, have you been doing these yet? I know we talked about this a couple of times about being able to enhance profitability, but have you been able to do these yet with the better entry?
I I haven't been able to trade the QQQs and the SPY, but um, XLI and XLK once in a while.
Okay.
But I, I was going to meet with you and tell you that I haven't been trading much since January because of health reasons.
Okay. All right. So we'll talk a little bit later on then.
But I'm back,
You're
and
back.
I'm back. Yes.
Are you still going to focus on futures or are you going to be getting back to options?
I've been while I was in my declining years, my declining months,
Okay.
I was into options, looking at options. And when I get serious about trading again, I will be doing futures.
Cool. All right. So I'm going to head back to the handout unless anyone has any questions. But like I said, this is just one strategy with the trigger lines. Um, it works extremely well with our um, market internals. I'm going to switch off the DIA. This is more recent trades. I'm going to change the share back to our spreadsheet. Like I said, I'm not showing all the regular trades from the daily chart strategy, just internals, but these are the regular trades on top of the internals. So this isn't even this listing that's on our website that you can download. This doesn't even include the internals. So this is just our regular trades with our 28 ETFs. And it's been a spectacular year for booking profits. I always tell people that I sometimes I oversimplify it, but it's very accurate. Every single year, expect to have at least, even at 84% wins is what we do on and higher on the ETFs. Every year, expect to have 2 to 3 losing months, period. Expected every single year. That will be offset by 2 to 3 winning months. Okay? Picture that. You got 4 to 6 months of, let's say, your first 2 months, nothing but wins. The next 2 months, losses. 4 months have gone by, you've made no money. And you're like, this doesn't work. This doesn't work. The trades, the wins and losses don't come when you want them to. It doesn't come when we want them to. You just position yourself to profit from the markets. We don't get to dictate to the markets when we feel we deserve to make money. I've had to work with people that really truly feel that they should tell the markets when to make money, and it doesn't work like that. Um, you will have losses, and losses won't be when you want them to happen. They'll happen when they happen. You just position yourself to make money, and the profits will happen. So with the 2 to 3 months of losses offset by 2 to 3 months of wins, that could be 6 months of trading, 4 to 6 months of trading that negate each other. The remaining 6 months is your profits from for the year. The remaining 6 to 8 months of trading, all your profits. The worst case scenario, you got 3 straight months of wins and then 3 straight months of losses. It can happen. So after 6 months, you made nothing, did all this work and made nothing. You keep trading. The next 6 months, that's your profits for the year. But you have to keep trading and you have to understand the big picture and not be like this. I had some coaching clients that froze up in March that they couldn't go long. I mean, they were like, Mark's going down, down, down. This
March is
is, ah. They
March
were,
was incredible. That's when the um, what would you call it? The rally started in
yeah,
mid-March or something like that,
it
and
was right there at the end. Yeah,
you
yeah. I
caught it,
I had one coaching client and he was
and,
just losing it. I mean,
and
losing
it
it.
continued. It continued,
Yeah, I
and
was like, dude,
so
you gotta place this trade. You gotta go long. And he had committed so much on the short side, but not committed financially, committed mentally. He was focusing on the news.
on
Uh,
the news, yeah.
he was he was blaming everyone in the world for the markets going down. He was blaming politicians. You know the politicians I'm talking about. I don't even have to say the names. He's blaming militaries, blaming everyone. I'm like, doesn't matter what it's out of your control.
Yes, where we learned that the market doesn't care about the wars. They don't
Exactly.
care about the war.
There's a war going on somewhere all the time.
Yeah, but that
It
was
just
that I also found really extraordinary. And there was this rally that nobody's. I mean, I don't know about the past, but the people who are looking at it go, they had never seen such a long-term rally like the one, while all this negativity in the
yeah,
background is going on. But now, now they're starting to focus on the true economy, the fact that people are going bankrupt, not paying their credit cards. And so who knows when the focus will change.
yeah. So yeah, I just go with the charts. The charts. That's why I don't focus on my energy on any news because no matter what news is going on, no matter what is happening, the way we do charts, this is I call this the end game because I spent well over 30,000 hours on developing all this stuff, myself and Becky. I mean, when I say 30,000 hours, I mean 30,000 plus hours. We spend many, many thousand hours back in the day, and now I spend probably maybe 7 to 8 hours a week still fine tuning. How can I make this better? And Becky spent a little bit less than that because once I find stuff, I think we got it to a point now where I can this might be better. So then I get together with her, and then we she does the spreadsheeting, does the back testing, and we decide is this worth continuing? Does it give us anything better than we already have? No, unless something gives us something better than we already have. Just another strategy. We don't need another strategy. Just unless it's better than what we have, and we just okay, moving on.
So did you stay with the first targets on these QQQs? And
I
Uh,
don't I don't
go
have
ahead.
I don't have time in my life to trail stops and manage positions. Other people do. Good for them. First target only. First target only, and I'm done. Same thing with the futures. First target and I'm done. I'll take my 40, 50% return on the first target and I'm done. That adds up really, really, really fast. Other people who want to put in the time, energy, and effort to manage positions, great for them. But most people just want, they have lives, they don't have time to. They have time, lives, businesses. They don't want to stress. You miss one position, you get screwed up. Um, but I'm probably, me personally, I'm a first target person and I look for better entries. So my better entry, so one win for me with a better entry is the equivalent of 3 to 4 wins for someone else getting in at the open the next day. See what I mean? Just by I will miss some trade.
Yes, you're looking for pullbacks
Exactly.
to get in, not
Yeah.
not taking the. So anyway, how does that relate to gap and go?
Well, the
Some
gap and well, internals, you have to know the internals are different. The internals don't look for pullbacks. Get in the trade.
mhm.
Those options have less time. So get in the trade. It's not
Yeah,
even
and then
worth
and the trick
get
is
it.
get out fast
Yeah, because those
for
options,
those gaps.
you're paying less for them. You have less time. Get in, let the trade go because some of those trades go fast, especially with the market internal. So just get in, get in, get in, and let it take care of its own itself. It's just leave it alone. All right, let's get back to the handout. Like I said, I got a couple hours worth of stuff here, but I'm only going. I try to control myself. Sometimes it's hard, but I'm going to go back to the handout.
Well, that was interesting that you found that the energy XLE is you're shorting that. That's interesting, and the XOP.
Well, once again, the charts are telling us it's time. What Olga's talking about is some of our strategies valid this weekend was giving us short-term, short trades on the energy sectors. So that's what she's talking about. Not on the stuff we're looking at here. It's on the email I sent out with the trades valid for this weekend. And we had a couple of shorts going on. So, and it all just tells you that um, heads up, people in the know.
Completely opposite to the news.
Yeah, it's like while people, oh no, the Strait of Hormuz is going to be closed forever and ever, and oil's going to go up forever and ever, and freak out while people in the know it's like, no, let's get our position. So um, sometimes it might go against you for a little bit, but you don't stress out over that. Markets go up, markets go down. As long as you're consistent, I put in the emails I sent out with the updates. Place 7 to 10 trades a month with the risk management we go over. You'll make money. I mean, literally play 7 to 10 trades a month. Almost doesn't matter what you trade as long as you go through the criteria I tell you to go through and keep the dollar risk management the way I tell you to do it. And understand you will have 2 to 3 losing months a year and you just have to keep trading and trade through it and keep trading and the numbers work themselves out and they work themselves out in your favor as long as you're consistent and don't make too many mistakes. And if you do make a mistake, let me know about it. Don't try to hide it. I know people I don't hear from for a while is because they messed up and don't want to tell me they messed up. Um, that's a common thing. So if you messed up, let me know. Let's fix it so it doesn't happen again. That's the benefit of having someone coaching you. You got someone to be accountable to. And I've had a couple of people that, like with futures, they'll be like, they'll contact me. It's like, I placed my futures trade, but something doesn't seem right with the numbers here. Can you help me check this out? And I was like, oh, were you planning to risk half your account on one trade? They're like, no. Well, you got a little typo in there that you're gonna risk. Oh crap, like that. It's like they saw something was wrong. They sensed something was wrong, but they couldn't figure out what, and they were literally risking a little typo made a big difference, and they didn't catch a typo. And those are the things that can blow your account up. So that's why it's good to have someone looking over your shoulder a little bit, checking out what you do, and you try to over time minimize those number of errors that we make. We will still make errors over time, but they become less and less. But it helps to have someone look at what you're doing because sometimes you're not making any money and not really sure why. Steve, were you saying something?
Oh yeah, my mic is on. The pullback thing's great, but like you said, if you go on vacation or you just I don't know. Do you play for that, or do you put a trade in and then if it goes down like
Yeah.
20 points, you put another trade in, or
Okay, that's this type of stuff I did way back in the day. Way back in the day, yes, to that way back in the day. Now it's just, hey, what's still valid? You come back
yeah,
from
I know,
vacation,
but
let's see
yeah,
what's
it's
still
kind
valid.
of hard to just predict that the market's going to go down for the next 3 or 4 weeks.
No,
You
so
know
there's
what I
nothing
mean?
planned. So you're not planning it. It's just like let's say you went on vacation, you weren't trading, but you go on vacation, you're not trading for a week. When you come back, what's still valid? Hey, the market went. This was valid last Saturday or Friday, and it pulled back. Let me get into this now. You've done those, right?
Yeah, of course.
Yeah,
Yeah, but
exactly. That's it. It's not planned. It just
usually there's times though where if I miss the trade, okay, I'm lucky that I missed the trade because now I'm making a better trade. But uh, usually I'm the type of guy that will take the trade and just be done with it. And like I said, live my life,
yeah.
so I'll make the trade like the following day in the morning. But who
The-
knows if the market's going to go up or down? Who knows if I should wait and make the trade a
yeah.
week or two from now?
If you wait, you might miss it. But I don't just
Ex-
by chance. I don't go looking for a pullback. Wait for it, but I might intentionally just pass on a trade until it pulls back. Then you risk missing it. That's fine.
right,
Like I said, one pullback trade is worth as much as 2 to 4 trades getting in at the open at the first target.
right. I hear you for sure,
Yeah.
but I mean,
So some
it's
of you
hard to.
have heard me talk about Steve, the person I worked with for way back when on trading. This is the Steve, by the way, just so you all know. This is Steve, the mysterious Steve that I've mentioned for years, but never, but no one ever saw you.
Oh, well, yeah. Well, you're still not seeing me.
Yes,
Uh,
I am. Your camera's on.
oh, it is. Well, I wouldn't know
Everyone's
that.
seeing you now.
I can't see myself. At
Yeah,
least
your
I can hear
camera's on, so
myself.
we're seeing you.
No,
I
but
was
yeah. Anyways, when you say it's great if you can make a trade like that, but you really can't predict a trade like
Exactly.
that.
Just by luck. Like right now, there are a whole bunch of trades that are still in play. And now there was another way to do that. A little more advanced on the trade management, but and you have to have more capital. Let's say you are willing to risk um, $4,000 a trade, and you're trading the
Right,
big boys. You're trading, or you're willing to risk $1,500 a trade. You're trading smaller, but let's say you got 2 contracts of $500 each
right.
at the open. You hold back the other 500 for a third contract.
Yeah, I've done stuff like that.
Yeah,
Sure.
exactly. That's how you do it. You get in maybe 2/3 of your position initially, and if there's a pullback, then you get in that last third. Otherwise, you end up missing part of your trade if it just takes off, but you're in it. What that'll do, it'll take something that might be a 15 to 20% return, but you got 1/3 of your position getting in at a much better price. So that might, but with the same first target, and that can change the 15, 20 something percent return to maybe 40 something percent return overall because that one contract that rather had a bigger return on it added on to the first two. So things like that. Basically, the more money you have, the more you can work with and more sophisticated trade position management like that. It just takes time, more effort to track it. But then you can be more comfortable. Oh, I got a big pullback. I had a position on. It's gone against me all this time. I'm going to get in way down here now, one more part of that position, and all of a sudden, huge profits.
Yeah, yeah. I've done that before. Going, well,
Exactly.
I'm just. Well, it's so cheap now. I'm gonna get another one.
Exactly. Yeah.
Yeah.
The probability of success hasn't changed, just the entry price has changed.
Yeah.
So,
Yeah, the other thing to look at is using what you're sending out, like the XLE and the XOP. The premiums are high because the VIX has gone up, and the premiums are higher to sell the like that one. You're indicating that you should short it, so maybe you can sell calls.
but then
Uh,
you create a whole different deal if you start selling premium. That's a whole different type of trading.
oh
Uh,
yeah, I agree, but
yeah.
I didn't mean it. If like
Uh,
you're making more money on the SPY and the QQQs, but these lesser ones, you can take less risk on those and do something like that,
Okay.
and just to be in the game,
Yes.
but not to like commit to a call or a put in those, because sometimes the spreads, particularly when the VIX is high, then you have the spread is quite large.
That's when trading stuff like the Qs becomes really good because there's still penny wide spreads. Um, of course, the Qs is going to run $2,000 to $3,000 for one contract. That's a little detail,
So
but
how
XLK is cheaper, but there is a big spread. But if you get a better price than expected, a much better price than expected, that negates the negatives introduced by the wider spread. So let's say your spread widened, but now you're getting in like 5, 6 points better than expected. So what if the spread widened? You totally made that up with and a whole lot more by getting in at a better price. So yeah, you might lose something with the spread widening, but you're gaining so much more because of the better entry price. So you have to think about stuff like that too.
Yeah, so how is the zero DTE? So many people are jumping on board the zero DTE. I
Okay.
wonder how that's going to affect the market. But so anyway, the semiconductors, I guess people got very greedy about the semiconductors and took the market up so high. But and AI, conceptually AI, um, the I guess that's the reason the market did that huge rally, unusual rally.
Okay.
But anyway, now all those are plummeting, and so is the Magnificent Seven. So it'll be interesting to see how those work out, especially with the zero DTE on those stocks.
Okay.
Yeah. So
So
yeah, they have
maybe
more week. They have more instead of weekly expirations. Now they have daily expirations and 2-day expirations.
that's why I just focus on the one expiration that's been there from day one, the third Friday of the month, and nothing else.
Third Friday of the month.
Third Friday of the month, nothing else. I don't care about all the
That's
things
for
that have
swing.
been
That's
created.
for the swing. For our
Yep,
swing.
for the swing trading. Yeah, way back when we tried the weekly, but it wasn't our comfort zone. Our comfort zone is having time to relax and not
Oh
worry
yeah.
about stuff.
Oh yeah. If you're gonna commit to a call or a put, you have to give it time.
Exactly. A lot of people don't realize you don't trade options. You need time, whether you're selling or buying, you need time. It's to make money. All right, so we've reached our time limit here. So
I had one question. Sorry,
yeah,
can I ask?
yeah, sure.
So you mentioned about put call ratio. It can be sold options, sold puts and sold calls, as well as bought
No,
put and
we're always buying calls or buying.
no, no. For the put call ratio, like to determine it, it can be
Oh yeah, yeah,
bought
yes,
puts and bought calls or sold puts and sold calls. So
yes.
how exactly do you differentiate whether that is like a bearish call or a bullish call based on PCR?
It's based on having by itself. You can't.
Right. So you said something like adjacent.
It
Uh,
has to have an a technical signal attached to it, and the put call ratio becomes the confirmation. Um, So I'm gonna switch real quick to the change the share real quickly. Choose. So see the spreadsheet here?
Yeah.
Okay. We had we run a scan, whether manual or visual, to find this gap and go trade signal. Okay.
Hmm.
And on that day, we had the trade signal. We look at the put call ratio. Did the put call ratio confirm the trade? Yes or no?
Oh,
We
okay.
could have gotten this signal on a different date. And then we go look at the put call ratio that day and it didn't confirm, so we got nothing. Um, Back in March when the markets was dropping, we could have gotten a trade signal at the beginning of March. Um, but if there's no confirmation from the put call ratio that day, we pass.
Oh,
These,
so you take the trade only if it confirms, like when
yes,
you have this particular strategy identified, and then the put call ratio actually confirms that, you know, um,
yes.
value of the put call ratio is something that
Yeah, these
you
strategies are
determines the.
exactly. These strategies are very simple. Like I showed you the example, just two lines crossing. You can't
Mhm.
make a career out of just looking at two lines crossing. We get a lot of fake outs, right? A lot of fake outs just looking for two lines crossing. So that's why we need something to confirm it. Two lines crossing is great, but we need something showing to this is the underlying, which you can't see in a chart that says, hey, the market internals are supporting this. There's something going on, right? As soon as you got a buy signal, at the same time you're getting a buy signal, there's something going on under the hood that says smart money is something with options, is a lot of volume is coming in. Something's coming in on one side more than the other. We don't know if it's long, if they're selling puts or buying puts, but there's something happening. Um, and that's our confirmation. And that's how we use the sentiment indicator. That's how we've been doing it for since 2007 or 8. It just works for us.
Okay, okay,
So
great.
that's how we do it. All right.
Thank you.
So and that's the same thing with our other strategies too. They're a little more complex strategies, but the same. Look for a visual setup, which is simple, something simple, and then the trigger is a confirmation, which we use to give us a high probability of 84%. So if anyone wants to work with me on
But
this, let me know.
that sounds like a question for Becky. Sounds like she's the authority on that.
Yeah, she's the one who tracks all that stuff and documents all the stats, and then we go over it. But yeah, we spent so much time on this stuff. We got to a point where we haven't really changed our option strategies in so long because they work. They just work. So we're very happy with our option strategies. They've been stable for many, many, many years now. No matter what the market's doing, as long as we're consistent, play 7 to 10 trades a month, you make money. Done. Period. And even though you're gonna have those months where it's like, oh my goodness, we have several expire out of the money, but people forget, yeah, you had several expire out of the money, but what about the ones that were winners? Oh, yeah, because those winners were offsetting the ones that off, and so your actual net decline in account value is really minimal, even with losses, because you're going to have wins the same month. So just be consistent with trading. Let me know if you want to work with me before Friday for the discount. I'll take $250 off, 250 off for either the futures or options program, and 750 off if you're doing both. It's always the best value. And there's a full options program with a daily and a weekly strategy. Some people like to have everything available to them. This also includes the internals, the market internals. So this package includes the internals. So you get the weekly, daily, and the internals. Um, the internals are not meant to be just by themselves because there's not that many trades, but it's something you add to everything else to give you more and enhance what you currently have. 8 strategies for the daily chart strategies, and it's just meant to generate cash flow, cash flow, cash flow. If you do what I tell you to do, follow the plan, and get in 7 to 10 trades a month. And you have to commit for at least 6 to 9 months to see the results, because you're going to have your ups and downs. Stuff happens. But once you commit, then you see the numbers your account starts to grow and the numbers work out, but you're always cash flowing. And it just works really, really, really well. I do everything one-on-one, and I review trades with you as often as you want to, daily, weekly, monthly. We set up something because it's one-on-one. I'll hold your hands if you need to place trades, not a problem. I will literally meet with you if you're local and to place trades. If you're local in the South Bay area, San Jose area, I'll meet with you in person or on Zoom, whatever you want. I like in person, at least the first time sometimes, if you're available to be around Santa Clara. But this is same thing with futures. And you can go through this in the handout, check the chat window. It's on our website also. And the ultra detailed stuff is in our FAQs page on our website. I put the ultra detailed stuff in here. Here's all the general information. But bottom line, it's one-on-one coaching, and we just get you trading live as quickly as possible. The actual analysis is not that challenging. It's just once I show you it, it's like, oh, is this easy to tell when the market is going up or down? Yes, it's that easy, but someone has to show you. And then you'll be like, wow, it's wow. But focusing on our sectors. Do stocks is a whole different world, but for our sectors, this works really, really, really well with options, just buying calls and puts. All right, I'm gonna have to wrap up now because we're kind of over time. Please call me, email me. My information is on the website. The contact page is also on the handouts, and I'm pretty reachable by phone or email. Call me, text me, message me via the contact form if you need to. And hopefully everyone's trading is going well, but this is time to start setting up. The best time to trade is the end of the year. So gear up now to be ready for the September, October timeframe. Every year I said that's our best time to trade and make the biggest profits because it has the biggest trends. So gear up now to be ready for the September, October timeframe, end of the year. All right, see you all in probably 3 weeks for our next meetup. It will probably be on futures, either the last weekend of June or after the July 4th weekend. So it'll either be the second weekend in July or the last weekend of June. We'll have our next meetup. All right, you all have a good weekend, and hopefully I'll talk to you about coaching, and love to be able to work with you. All right, see you all soon then.
Bye.
See ya.